The top hedge fund managers in America paid a lower effective tax rate than most nurses last year. Not an accident. It is a deliberate system. Every strategy is completely legal. Here's exactly how it works. Not all income is taxed the same. This is the gap most people never close. Salary income is taxed as ordinary income. Federal rates hit 37% at the top. Add state taxes. Most high earners pay close to 50% combined. Wealthy people convert income into long-term capital gains. Investment profits held longer than 1 year. The top federal rate on those gains is 20%. Same $100,000 of income. Different classification. Different tax bill. The IRS does not care how hard you worked for the money. It cares how the money was categorized. That is the first legal advantage, and it is available to anyone who restructures how they earn. Here's the strategy billionaires actually use. It is called buy, borrow, die. Entirely legal. You buy an asset, stock, real estate, a business. You let it appreciate. You never sell. Selling creates a taxable event. Instead, you borrow against it. Banks will lend you money against your portfolio as collateral. Loan proceeds are not income. They are not taxable. You live on borrowed money. You repay with future asset sales. When you die, your heirs inherit the assets at a stepped-up cost basis. The unrealized gains are permanently erased. Zero capital gains tax, ever. This is how the ultra-wealthy earn billions while reporting minimal taxable income each year. If you own a business or can qualify as one, the tax code becomes your friend. Every expense connected to earning income is potentially deductible. Home office, vehicle mileage, travel, equipment, health insurance premiums, retirement contributions. A self-employed person earning $150,000 who properly deducts legitimate business expenses can reduce taxable income to $90,000 or less. That's thousands in taxes legally removed before the IRS sees them. The wealthy don't just earn money, they run it through structures designed to maximize deductions. S corporations, LLCs, sole proprietorships, not to hide income, to apply every legal deduction the tax code already offers. The code rewards business owners. It was written that way. Here's one the wealthy almost never talk about publicly: real estate depreciation. When you own rental property, the IRS lets you deduct a portion of the building's value every year, even while the actual value increases. A $400,000 rental can generate $10,000 to $14,000 in annual depreciation deductions. That's $10,000 to $14,000 of income that becomes invisible to the IRS. Wealthy real estate investors use something called bonus depreciation to wipe out even larger amounts in a single year. Combined with a cost segregation study, they routinely report zero taxable income on properties generating hundreds of thousands in cash. The building depreciates on paper. The cash grows in reality. This one is available to anyone with a brokerage account. Tax loss harvesting. When a position in your portfolio loses value, you sell it. Not because you want out, because the loss creates a tax deduction. You use that loss to offset gains elsewhere. If losses exceed gains, you can deduct up to $3,000 of ordinary income per year. Unused losses carry forward indefinitely. Wealthy investors do this systematically. All year, every year, the portfolio still grows. It simultaneously generates thousands in annual tax savings. The IRS allows you to sell at a loss and immediately buy a similar fund. You stay invested. You book the loss. You save the taxes. Wealthy people don't just donate to charity. They structure it as a tax strategy, the donor-advised fund. You contribute cash or appreciated stock to a DAF. You get an immediate full tax deduction. The money grows tax-free inside the fund. You distribute to charities over time on your own schedule. Even more powerful, donate appreciated stock directly. You bought stock at $10. It's now worth $100. Sell it and you owe capital gains on the $90 gain. Donate it instead. You deduct the full $100 market value. Zero capital gains tax owed. You give more, pay less. The IRS designed this incentive. It has been in the tax code for decades. Now here is what you can actually do starting this year. The tax code gives everyone the same retirement account tools. Most people don't max them out. The 401k, $23,500 in pre-tax contributions for 2026. If you're 50 or older, $31,000. That money is removed from your taxable income the moment it goes in. The backdoor Roth IRA, $7,000 a year growing completely tax-free. High earners who can't contribute directly use the backdoor conversion. Legal, IRS approved. The HSA, $4,300 in 2026 for individuals. Triple tax advantaged. Contributions are pre-tax. Growth is tax-free. Withdrawals for medical are tax-free. These are the tools wealthy people use before everything else. Every single year. Here is what all of this comes down to. The wealthy don't pay less tax because the system is unfair. They pay less tax because they understand the system, and they use every tool it provides. You have access to the same tax code, the same accounts, the same strategies applied at your scale. Capital gains rates, retirement accounts, business deductions, charitable structures, tax loss harvesting. The code was written with these tools inside it. Most people never bothered to look. The ones who look are the ones who keep more of what they earn. Drop a comment. Which strategy here did you not know existed before this video? Subscribe. Every week, one financial move that changes the number.